UnitedHealth Group Incorporated, stock ticker UNH, just released their latest quarter's earnings, and the stock was up big on the day, up about 6.5%, and we can see they're now trading at $548.87 per share. So in this video, we're going to be looking at that recent earnings report, analyzing the company, and like always, seeing if we can calculate the intrinsic value. So let's go ahead and jump into it. Now, if we go ahead and glance at this earnings report, we can see Q2 non-GAAP earnings per share came in at $6.80, which was a beat by about 17 cents, and revenue came in at about $98.9 billion, which was up 6.4% year over year and was in line with analysts' expectations. And if we scroll down, we can see the company also reaffirmed their prior guidance. So the market seems to really like what they saw from this earnings report. Now, UNH is a company that I own in my personal portfolio. If we go over to my do-it-yourself investor toolkit and blow up my growth chart, you can actually see it was the most recent new addition to my portfolio, and I'm almost up 21% on this position as of right now. If we go back over to Seeking Alpha, we can see over the past year, they're up about 13.38%, and year to date, up about 4.25%. Now, when I added this company to my portfolio, it was in this range here. We can see early April. And the reason this company took this huge nosedive was some pretty bad news surrounding the company. UnitedHealth Group had to pay more than $3 billion to providers following a cyber attack. This was a big deal, and $3 billion is obviously a lot of money. And if we look at the recent earnings report, they just gave an update on this cyber attack. They stated that to date, the company's provided over $9 billion in advance funding and interest-free loans to support care providers. Total cyber attack impacts in the second quarter were 92 cents per share. So this was a very big deal, and they had already paid out over $3 billion as of March of 27th. But to put this in perspective, if we jump over to the company's balance sheet breakdown again, you can download any of my sheets on tickerdata.com and also get access to the Ticker Data add-on in Google Sheets that allows you to automatically import stock financials. But if we come up here and plug in UNH and hit enter, and we can see all this data will load in. Now, like I said, they had already paid out over $3 billion, but to put this into perspective, this is a massive company. If we look at their cash and cash equivalents as of the end of 2023, it was sitting at over $25 billion, and if we look at the total current assets at the end of 2023, over $78 billion. So overall, I think the market may have overreacted to this news. We can see this put shares as low as around $439 per share. And around this time is actually the time that I started adding shares to my portfolio. Now, what you have to understand about this purchase in my portfolio is this didn't just have to do with valuation. This also had to do with the quality of the earnings of this business and the quality of the dividend payments. So to put this into perspective, if we jump over to my dividend breakdown sheet, come up here, we'll plug in UNH and hit enter. And we can see this data will load in. Now, the starting dividend yield for this company is not too high. It's sitting at about 1.53%, so nothing too crazy. But the dividend growth is absolutely phenomenal. Look at the 10-year dividend CAGR, sitting close to 20%, in the 5-year dividend CAGR, close to 15.2%, and we can see the payout ratios are in a very healthy range as well. So to put this dividend growth into perspective, we can see in 2013, they're paying out about $1.05 per share, 2023, $7.29, and it's now up to $8.40 per share. And this is all backed by free cash flow growth. The 10-year free cash flow CAGR sitting at about 16%, and the 5-year free cash flow CAGR sitting at about 13.5%. So this is exactly what I'm looking for when I'm thinking about my long-term goals. The long-term goal for my portfolio is to one day live off dividend payments. So in order for that to happen, I need to buy quality companies that can constantly increase the amount they're paying out in dividends. And to be able to do that, they have to be growing their free cash flow year over year, and ideally not really increasing their free cash flow payout ratio over time. So we can see that's exactly what is happening with UNH. If we look at the free cash flow versus dividends paid out, free cash flow has exploded over the past decade, allowing them to grow their dividend payments during that time period, and the free cash flow payout ratio has consistently stayed below 30% for the entirety of this time period. So when I as an investor think about things I'm willing to pay a premium for, I want to buy stocks where the dividend growth is predictable, where it's very stable. And when I look at UNH, that's exactly what I see. If we jump over to my stock screener tab, come up here, plug in UNH and hit enter, we can see pretty much the exact same thing. Very stable, very predictable growth pretty much year over year. This is an absolute beautiful chart when it comes to revenue per share. The same is true with earnings per share and free cash flow per share. We're basically seeing growth every single year in this chart. We can see that debt to assets ratio sitting at a healthy range. They are slowly buying back shares as well, and return on invested capital again, very stable, very predictable. We can see it's pretty much been sitting just at 15% since about 2017. If we jump over to my profitability and income statement sheet, we can see double-digit growth with 10 and 5-year revenue CAGRs, and the same is true with the net income CAGRs. Both are very good, and we can see the gross profit ratio is staying steady as well. They have a 10-year average gross profit ratio of about 23.92%, and the gross profit ratio in 2023 was actually a little bit higher, sitting at about 24.5%. So when I purchased this company, not only was it trading at a great valuation due to an overreaction, but this is a high quality company that I could hold for the very long term for my portfolio. It fits perfectly in line with what I'm looking for out of the companies I want to purchase, and it fits in line with my goals of one day living off dividend income. And when we think about the industry that they're growing in, there's no doubt it's going to continue to grow over time. If we look at historical national health expenditures, we can see it's been growing at a pretty decent rate up until this time period, and it's projected to continue to grow at a pretty high rate as well. And I think UNH will follow. Now, if we dig into this earnings report a little bit closer, we can see exactly where their revenues are coming from as of right now. And really, there are three main areas. We can see they have premiums, products, and services, but they also have investment and other income, but this is pretty insignificant in the grand scheme of things. So if we break this down, we can see premiums. This is by far the hugest revenue driver. And keep in mind, we are looking at this in millions as of right now. So decent growth from 2023 to 2024. And keep in mind, we're looking at the 3 months ended right here. Over here on the right, we have 6 months ended. And in both scenarios, we saw pretty decent growth with premiums. Products continue to grow as well. We can see decent growth from year over year. And then we can see with services, they saw a little bit of growth, but it wasn't a whole lot. And then investment and other income was down slightly, but that's not really something I'm concerned about. And then earlier we touched on the cash and cash equivalents as of the end of 2023, sitting at about 25 billion. But if we look at the most recent earnings report, we can now see as of June 30th, 2024, this was sitting at about 31 billion. So yes, the company did face some headwinds with that cyber attack, and they are still feeling some of the effects of that problem. But in my opinion, this really created more of a short-term opportunity. This was a little bit of an overreaction when it sold all the way down to $439 per share. And with this most recent earnings report, I think investors are starting to remember that again. So the question we have to ask ourselves now, with the company trading at $548 per share, is it still considered a good buy at this price? Is it undervalued? And to answer that question, let's go ahead and jump over to my stock valuation spreadsheets. Come up here, plug in UNH, and the data loads in. And one of the things that I do want to point out is the beta is actually decently low, sitting at 0.6. So this is a company with much lower levels of volatility than that of the market, which I know for some people is actually a pretty big plus. Now, the first valuation we're going to look at is going to be Graham's valuation. And if we go ahead and zoom in, you can see our formula here, but basically we're valuing the company based on its current earnings per share, the projected growth rate, and also taking into account current market conditions. Now we have estimated earnings per share average. You can see this is pulled in with the ticker data function right here, so we can automatically plug this in, and this is based off the average of other analyst estimates. Then we apply our growth rate projection. I'm staying in line with analysts again, going with about 12. Then we divide all of this by Y, which is the current yield on AAA corporate bonds, currently sitting at about 4.77, a little bit higher than it has been historically over the past 5 to 10 years, which will drive down this valuation. So we come to an intrinsic value of about $485.48 per share. Now, the next valuation we're going to look at is going to be our discounted cash flow analysis. We're valuing the company based on how much free cash flow it's projected to produce in the future. So to plug in a growth rate projection, we analyze the historical free cash flows, look at analyst expectations and industry expectations, and we went with a growth rate projection of about 8% to the future free cash flows of the company. We then find the present value of those future free cash flows and add them together, add the company's cash and cash equivalents, subtract out total debt to get equity value, divide by shares outstanding, and we come to a DCF price per share of $616. Then finally, we'll look at our dividend discount model. And the idea behind this is we should be able to value the company based on how much they're paying out in dividends and how much that dividend is increasing over time. So I'm going with a dividend growth rate projection of about 7%. And keep in mind that honestly may be a little bit more on the conservative side. The past 5 years have been 15.2, in the past 10 years, 19.6. So short term, obviously they're capable of a lot more, but 7% still a pretty high dividend growth rate projection over the long term. But with a discount rate of 8.5%, we come to a DDM price per share of right at $600. So when we jump over to our output tab, we can see the three valuations that we use: Graham's at 485, DCF at 616, and then dividend discount model at 599.20. And when we average those three together, we come to an intrinsic value of $566.93. Decently close to the current trading price, but the current trading price is still about 3% lower than the intrinsic value that we came to. So with a 10% margin of safety, it looks like that acceptable buy price sitting at about $510.24, and with a 20% margin of safety, acceptable buy price of $453.55. Now, what's interesting about this is you typically don't see high quality companies trade within a 20% margin of safety. And in the case of UNH, with a 20% margin of safety, we can see acceptable buy price of $453. They actually reached this price when the news of the cyber attack came out. So here's what you have to understand as a long-term investor. When you hear news like this, you have to analyze how does it affect the company long-term, not just in the short term, but the long-term. And when I heard this news, this did look like more of a short-term problem. Yes, definitely affected the balance sheet short-term and was not good publicity for the company. But again, their cash and cash equivalents could easily cover the cost of this problem. So when I heard the news of the cyber attack, analyzed the company, and looked into them quite a bit deeper, it did look like an opportunity, and so far it looks like that opportunity has paid off. Again, based off of our valuation, it still looks like they may even be undervalued by about 3%, but it's pretty close to fair value as of right now. But with that being said, I think this is a high quality company. I'm willing to pay a little bit more for companies that I think are very predictable and very stable with their free cash flow per share growth, with their earnings growth, and with their dividend growth. But there you go, there's an analysis on UnitedHealth Group and a quick glance at their recent earnings report. Go ahead and let me know what you think of this company in the comments down below. And like always, if you'd like to be able to download any of my spreadsheets and also get access to the ticker data add-on in Google Sheets that allows you to automatically import stock financials straight into your spreadsheet, then you can head over to tickerdata.com at the link in the description. So with all that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.